welcome to the deep dive. Today, we're really getting into something crucial for S-Corp owners.
Mm-hmm.
How do you actually unlock those tax benefits? And maybe more importantly, how do you avoid the traps?
Right, the ones that can sneak up on you.
Exactly.
Mm.
So our mission today, using expert research, is to give you those vital insights for your personal tax situation, helping you use these rules for, real wealth building.
Sounds good.
Okay, so let's start with the basics. There's this fundamental tension, isn't there, between GAAP, that's generally accepted accounting principles.
Right, for the investors, the banks.
Yeah, showing a fair picture. And then you've got the tax code, the IRC, its job, raising money in policy.
Totally different objectives.
Yep.
Which means for your S-Corp, your books, and your tax return, they're almost certainly going to look different.
And understanding why they're different, that's where the strategy comes in.
Precisely. And these book tax differences, they basically fall into two main categories. You've got permanent ones.
Permanent, meaning they never switch back.
Exactly. Think interest from municipal bonds, tax-free, right? Or that 50% of meals you can't deduct, or government fines, never deductible.
Got it. And the other type.
Those are temporary differences, all about timing. They will reverse later.
Like depreciation, using accelerated methods for tax versus straight line for the books.
Perfect example. Or maybe how you account for bad debt expense. It's just a timing difference.
Okay, now this is where it gets really interesting for me. These temporary differences, they actually show up on your balance sheet, right?
Mm-hmm.
As DTAs or DTLs.
Yes, deferred tax assets or deferred tax liabilities.
So a DTL, a deferred tax liability, it's kind of like getting an interest-free loan from the government because you're pushing tax payments into the future.
That's a good way to think about it, yeah. You pay less tax now.
That sounds great short term.
Yeah.
But how does the IRS see all this? How does it get reported on the actual Form 1120-S?
Right, that's the critical link. The 1120-S is the map. Page 1 calculates your ordinary business income. Pretty standard stuff. But then you flip to Schedule K, and the K ones that go to you, the shareholder. That's where you find separately stated items.
Things like capital gains, Section 179.
Exactly. They pass through individually because how they're taxed depends entirely on your personal tax situation, not the S-Corp.
Right. And speaking of the personal side, there's this huge potential pitfall, non-deductible expenses.
Oh, absolutely. A big one.
These are real costs, money out the door for the S-Corp, but zero tax deduction.
Correct.
And if you forget to reduce your shareholder basis for these, like that 50% non-deductible part of meals or fines.
That's the basis trap. It's incredibly common.
And costly. You could suddenly owe tax on distributions you thought were tax-free returns of your investment.
Or find your losses are stuck, suspended because you don't have enough basis to deduct them.
It's like thinking you got a deduction, but then realizing you wiped it out yourself through an oversight.
Yeah, that's a painful surprise. And connecting this all together, you have the reconciliation schedules. Schedule M1 is the basic one.
The bridge between book and tax income.
Right. But for larger S-Corp, there's Schedule M3. It's much more detailed.
More detailed how?
It forces you to classify every single book tax difference as either temporary or permanent, line by line.
Wow, okay. So that's basically laying it all out for the IRS.
Exactly.
Huh.
It's often called an audit roadmap for them. They can see exactly where your book and tax numbers diverge and why.
Okay, so knowing all this, how do we use it strategically? You mentioned depreciation earlier.
Yes. Accelerated methods like bonus depreciation or Section 179 are, premier tools. They can dramatically cut your current taxable income.
Deferring tax, boosting cash flow now. Sounds like a win.
It often is. But remember, the gateway to actually realizing these benefits and taking those tax-free distributions is managing your shareholder basis meticulously.
It always comes back to basis, doesn't it?
It really does. Aggressive depreciation reduces your basis faster, so you need to track it carefully to avoid hitting that basis trap sooner.
So the bottom line is documentation.
Absolutely. Robust documentation for everything. Receipts, logs, invoices, statements. Keep it organized.
So proactively reviewing your trial balance, maybe keeping good digital records. That's your best defense if the IRS comes knocking.
It transforms an audit from a potential crisis into just verification, routine.
So understanding these S-Corp tax details isn't just about compliance, is it? It's really about strategy.
It's about maximizing your after-tax wealth as the shareholder.
Which leads to a really important final thought for you, the listener.
How closely are you actually tracking your basis and keeping those records? And what opportunities or maybe hidden traps might be sitting there in your S-Corp right now?